Well, thanks very much, Candice, and it's great to be back to the Shared Services Conference. Any of you who was here 2 years ago will have seen that last time it was all about slides. This time we thought we'd have a change of pace. So my colleague Anna, who's the Chief Economist in a Spanish firm, has joined us for a discussion. So we were trying to work out how best to do this session, and we thought a good way of doing it would be to say, what are the things that as economists we keep talking about which really matter for you? And actually, over the course of the day, we've heard a lot of the themes that we're about to talk to coming through. So we've chosen 5 big themes, and we're going to do it as a conversation. So, Anna, I mean, we've got this slide up on the screen, and I guess there's economists are talking a lot about this term immaculate disinflation. What they mean is it possible for central banks to get inflation down without causing a recession? And if we'd been here a year ago, I would have said, yep, there's going to be a recession in the States, there's going to be one in Europe, and it hasn't happened. So this is the big question. Will we see a recession in Europe in the next sort of 18 months in the world? So, Anna, look, first question, why on earth hasn't there been a recession? Because interest rates have gone through the roof.
Okay, so good afternoon, everyone, and it's a pleasure to join you, Ian, and the audience to talk about the macroeconomic scenario at these uncertain times. It's a very good question, and we economists have been thinking about this for some time. I would say that there is a number of factors that in this environment have helped us maintain growth despite the uncertainty. The first factor that I would mention is the fact that over the last decade, households and firms went through a process of reducing their level of debt. They today have got a much smaller level of debt compared to what they had during the global financial crisis, and that has meant that they were in a much stronger position to be able to face up to the current scenario that we have. So that is one factor. A second factor is the fact that the pandemic led to forced changes in our habits. We're not able to spend for some time as much as we would typically spend. And also governments rushed to introduce a number of income support measures in order to help people through the difficult times. So this led to a certain amount of savings accumulated that helped maintain consumption during the period of high inflation. A third factor would be the dynamism that we've seen in the labor market, which has been surprising. Companies have continued to employ despite the uncertainty and despite the challenges to growth. Both factors have helped maintain a level of consumption during these times. And the last one that I would mention is the fact that there has also been a shift in terms of the structure of interest rates under which people and firms have got their debt. So the fact that there is a certain amount of debt under fixed rates also means that we as firms and people have been able to mitigate some of that impact of the sharp increase in interest rates.
So there has been a big slowdown across the West, and I think Germany was originally in recession. It was revised out of recession, but is expected to go into recession. But America hasn't gone into recession, nor the UK, nor Europe as a whole, but there's been a big slowdown. Now, look, we're not out of the woods, because we all know that interest rates affect economies with famously long and variable lags. So maybe there's a lot of distress coming through. Just for this audience, how should they think about growth in Europe over the next 18 months, Anna?
Yes, I mean, I think that the big question is whether we will be able to maintain this growth and whether businesses can plan under that scenario, or whether we will see a hard landing in the economy. I think that those economists that see their inflation moderate sooner before the full effect of interest rates materializes are the ones that are more likely to be able to experience a soft landing. And so with that framework in mind and thinking about the different territories where your business operations likely work, I expect that the US is the economy that is closest to being able to achieve a soft landing. Europe at the moment is facing more challenges because we've been able to moderate inflation, but not yet enough to get closer to the objectives. And our core inflation is still sticky relative to the US. So the outlook in Europe is more challenging. I do think that we will see some slowdown. and probably a couple of quarters of contraction in the economy, but this, I expect, will be a mild contraction rather than a severe contraction. Nonetheless, even if the soft landing scenario is the central scenario, as businesses, I think we have to recognize that we cannot rule out other scenarios given the degree of uncertainty. We cannot rule out, given the downside risk that exists, that things could be a little bit more challenging than that. And so I think it's important that businesses do contingency planning whilst continuing to operate in a soft landing scenario, that they do contingency planning for other possible scenarios that cannot yet be ruled out.
So basically, you think it's most likely there'll be a soft landing, a kind of trough in growth in the first half of next year, and then a pickup in activity, but you can't discount the risk of a deeper recession.
Indeed,
Yeah.
That's what I would expect. So I think, Ian, that takes us to our second topic, which is very much related, and it's the subject of interest rates. And the question that I certainly get asked a lot, and I'm sure you do as well, Ian, which is the question about for how much longer will we have these high interest rates that we have today. So we wanted to give the audience a little bit of historic context for this question, and we have it there on the slide. So as we can see, going back in time a great deal, the pandemic has really put an end to a trend that we had seen for about 4 decades. During the 80s, we saw a peak in rates and inflation, and since then, they were moderating towards a period just a few years before the pandemic that actually was considered by policymakers to be a time of deflation. Deflation was what worrying policymakers. But the pandemic has changed this, and as you can see on the graph, it's taken us to levels of inflation and interest rates that are similar to the levels that we had during the 90s. So Ian, I think the question here comes, for how much longer do you think that we will have these higher rates that we have today? But even more interesting, a question that I get asked is, when they start to moderate interest rates, are they likely to go back to the levels that we had pre-pandemic, which as we can see were low, or are they likely to go back to a different level?
Yeah, this is a huge question because, I mean, we've been living in a world of cheap money for the last 40 years, and I think we underestimate just how important it has been to asset values, the ability to raise finance, liquidity. It's had huge and pervasive effects. So yeah, you're right. I mean, we've seen an explosion in inflation that nobody expected, with inflation hitting 10% or higher or thereabouts. And central banks have reacted very aggressively. We've had the biggest tightening of monetary policy, I think, in 40 years. I think what we're going to see is inflation falling over the next 18 months. A lot of the supply chain problems, soaring commodity prices, energy prices, are probably behind us. Query about energy. So I think we should assume that inflation falls next year. I mean, central banks, the ECB, the Fed, don't expect inflation in Europe and the States to get back to 2% till 2025. So it's quite a long wait. But I think, perhaps this is the subject of your next question about, well, if you're a company, how do you think about it? Because there's the cycle, and then there's the long-term question.
Indeed. What sort of assumptions do you think that businesses should make about the cost of capital, about the cost of financing going forwards in this environment? Yeah,
so I think we're probably fairly close to the peak in rates in Europe. US, perhaps another 25 50 basis points to go. So I think we're getting to the top. And I think the rates will fall towards the end of next year and in 2025. Longer term, though, to answer your question, if I were running a business, I would not assume that interest rates are going to go back to the levels that we saw before the pandemic. Globalization, which is a big killer of inflation, is much weaker than it was. Central banks are unwinding quantitative easing, they're quantitative tightening. Well, what that means is that interest rates are going to be higher in the long term. There's a lot of talk about greenflation, the way in which the energy transition is going to cost money and is going to put up prices, and I think that's quite credible. So for all these reasons, I think we're looking at a world in which interest rates in Europe are going to be sort of trend around about the 2%. around about 3% in the States. These aren't sky-high levels, but they're a lot higher than the levels that we got used to before the pandemic.
Indeed.
So the next hot topic, and I know actually this, for everyone here, this subject really matters, globalization. And the chart you're looking at is just a really lovely, simple way of thinking about globalization. You know, the 20th and 21st century has been an incredible period of globalization, and it has really taken off in the period from the late 70s, and it's lost momentum. And it lost momentum after the financial crisis, pandemic, Brexit, Trump, all these things have weighed on it. So Anna, you know, for this audience, how should they think about globalization? Is globalization over, or, you know, all these headwinds? What do you think?
Ian, I really don't think that we can talk about deglobalization. Deglobalization would mean that we would unwind globalization. I don't think we can talk about that. What we can certainly talk about is changes in the patterns of globalization that we are certainly seeing, and certainly businesses will have to adapt to this new environment. If we look at different data sets, they support this view that I'm sharing, that I don't think globalization is that. For example, when we look at trade, global trade as a share of GDP, we can see that that stagnated around the global financial crisis, but it has not come down. Similar picture with FDI, for example. It's growing more slowly, but it's not come down. The stock of FDI over GDP continues to increase. And of course, we know that governments around the world continue to be very keen to sign up to trade deals. There have been a number of them signed up relatively recently. So I don't think it's dead. But as I said, I do think that the patterns are changing, and we need to adapt to these. Patterns are changing. For example, we see it evidenced in Brexit, of course. We see it evidenced in the US-China trade war, in the Russian sanctions. We see it in a number of places where it's very evident, but also in other places where it's a bit more subtle, such as, for example, in the proliferation of industrial policies that we have seen over the last 2-3 years, such as the Inflation Reduction Act, where actually there are provisions for domestic supply to favor domestic suppliers. So that is interesting. That is a shift. Or in the removal of FDI from China to a certain degree, and the increase in friendshoring. There is very interesting data about what happened to US imports after the US-China trade war started. We can see that despite the increase in tariffs on both sides, US imports continued to increase. So this means that the US did not become self-sufficient as a result of that war. But we can also see that most of the share that was taken away from China actually went to Southeast Asia. Some of it went to Canada and Mexico, but most of it went to Southeast Asia. So I think what this demonstrates is that this chapter, the trade war, did not lead to deglobalization, it did not lead to onshoring, and it also did not lead to nearshoring. If anything, it led to friendshoring.
Interesting. So you're thinking about an era of globalization, which is there's more friction, there are more challenges, but it goes on. So, you know, for corporates, how should they think about globalization? Because, you know, really the period until the financial crisis is extraordinary. You kind of have an assumption of increasing interconnectedness. How should corporates think about this new type of globalization, Anna?
Well, a little bit like with the economy overall, I don't think businesses can renounce to trade. They cannot renounce to the benefits of market access. They cannot renounce to the benefits of efficiency that trade provides. So they need to continue to engage in trade, but certainly they need to shift to the new environment, which is certainly an environment of greater political contestation, if we can put it that way. So in that context, there are risks. So country risk and geopolitical risks are factors that, again, become critical in decision-making and in planning. But also there are opportunities. There are opportunities related to new frontiers of globalization, new places like India, like, as I mentioned, Southeast Asia, Mexico, or Africa, to mention just a few. In these times of change, I think it is critical to stay informed and to be very rapid, be very agile to be able to adapt to these changes to maximize the opportunities that they also offer.
Okay, so not the end of globalization, but a rather different, perhaps more fractious kind of globalization, but with still big benefits.
Indeed, indeed. I think, Ian, that takes us to our next topic, which actually is very much related to the previous one. It's the subject about net zero and climate change. It's very much related to the previous one because actually a lot of the proliferation of industrial policies that we have seen over the last 2-3 years have got to do with the race to net zero. So as you all know, from the time of the Industrial Revolution, as a result of greenhouse gas emissions, temperatures started to rise. So the international community came together in Paris to agree that we will look to limit the increase in temperature in the world to 1.5 degrees. They agreed to net zero by 2050. And we can see there that some parts of the world have been making progress towards those targets. We can see there that Europe, for example, has decided to take steps to decouple our growth from emissions. So we've started to reduce emissions. But if we are to come close, Ian, to the objectives that we have, all countries need to align with these objectives. So that means that developed countries will have to work together with developing nations in order to contain emissions. The really critical point for us as economists, Ian, in relation to climate change and net zero is that climate change and net zero are not adjacent topics. They're very much at the center of how the economic scenario will shape out. They will have a profound and complete impact on the economic scenarios that we see over the next years. So given the critical importance of climate change and net zero, Ian, do you think we're on track to meet the targets? How are we doing?
Yeah, well, you know what, Anna, I think there's good news and bad news on this, and I think the good news is illustrated by the chart that Anna's showed you. I mean, in Europe, to some extent in the States, we have managed to kind of decouple economic activity from emissions. That is the secret of growing economies, but also decarbonizing. And the achievement is pretty considerable. The problem is that this isn't happening around the world. And I just want to give you a kind of an idea of the order of magnitude. To hit net zero, now remember what net zero means. By 2050, we have limited the increase in the global climate to an increase of 1.5 degrees centigrade relative to the kind of averages pre-industrial revolution. To hit that target, that's the Paris target, we need to be seeing carbon emissions falling by about 8% a year. Well, last year they grew by about 2%, and even in the pandemic, a seismic contraction in growth, carbon emissions only fell about 4%. So the point is that there are great things happening. The pace of the transformation or the rollout of solar and wind has exceeded all expectations. The fall in the costs of these technologies have exceeded all expectations. But we still have a huge problem about emissions. So I think the answer is there's a lot more to do, Anna.
And what can businesses do then? How can they reap the opportunities, but also adapt to the challenges and the risks with net zero?
Well, I think this is the big question. And, Anna, I think that, so as economists, we look at this and we think, wow, this is the biggest kind of issue of, not our generation, but our children's generation, the generation after that. And I think it is a completely pervasive business risk. And what I mean by that is it doesn't belong in ESG. It's something which is going to affect brand, talent, the value of assets, costs, the value, the kind of future of businesses. So we had a conversation with a group of CFOs about climate recently, and it's clear that they're big companies, that they see this as a kind of just a completely all-engulfing business issue. I think a simple way of understanding this and what it means for you is that if we were to get on the right path for net zero, we would all need to be paying about over $100 a ton to emit carbon. So there is a carbon tax in Europe. It doesn't cover everything, but it's levied at about $4. So the gap between what we're paying to emit and the damage it's causing to the environment is huge. And it goes back to the earlier point about greenflation. I think we have got to think that the cost of emitting energy is going to rise, that the penalty for doing so is going to be greater. And I think what it means is that businesses which are ahead of the game and have thought about these things will be in a real advantage, Anna. So I think it's just one of those issues that's, it's a kind of, here forever. So I think this is our final topic, Anna. And yeah, technology. This is a subject that comes up particularly since November of last year when ChatGPT was unveiled. Suddenly, technology's a hot economic issue. So I know for you, it's something that you're thinking about in terms of your own operations, but it raises major economic issues, particularly about jobs and productivity. And the history is just fantastic news from the history. So just look at the number of jobs in the US economy. They've gone from about 60 million with a bit of a reverse in the pandemic to over 160 million. Huge growth in the number of employment in the States. And remember, this is in a period of staggering technological change. You think of all the technologies that have come through in the last 70 years or so. So the history is that actually technology is really good for jobs. That it doesn't destroy jobs in total, but it tends to be good for productivity. But Anna, will it be different this time around with artificial intelligence? What's your feeling? Should we be optimistic about technology?
I am optimistic, Ian. I do think that AI over the medium term will help increase productivity, and it will help increase jobs as well. I very much like thinking about the latest generation of artificial intelligence as amplified intelligence, not just artificial intelligence. It is almost like the artistic side of artificial intelligence. So just if we know the right questions to ask, it can really trigger a process of creativity, of generating new content, generating original content. For that reason, I think that generative AI, will help us develop new business models. It will help us develop new solutions. And so over the medium term, that should lead to new demands and new ecosystems that will give rise to more employment. So I'm optimistic that we will continue to see that trend overall. Of course, we must say that this doesn't happen immediately and with no action. In these times of shift, it will be particularly critical to have the right policies in place at the business level and at the economy level in order to ensure that those people whose tasks are being automated, that they acquire and develop the skills that will be required in order to be able to respond to the new demands. So reskilling, upskilling, that is much talked about, I think will be of critical importance.
So you see it as being kind of disruptive, but a net creator of growth and of jobs. What is the implication for businesses as they think about how AI and other new technologies are going to change the environment over the coming years, do you think?
So I think the implications will be massive, and we probably do not yet understand the wide range of implications. But I would say we've established that it's likely to create productivity. So that takes us to saying, of course, businesses will have to embrace AI and embed AI in their organizations. This will require a number of things. It will require that employees feel confident to be able to acquire the skills and knowledge that they need in order to be able to use AI. It requires that executives also acquire knowledge so that they can take decisions about where it's appropriate to use AI. And also, I think we need to nonetheless be mindful of something that Ian, you and I were talking about over lunch, and it's the fact that although AI is certainly a great improvement and it helps achieve great efficiency, AI doesn't always get it right at the moment. So it will be important that we have structures in place that allow experimentation, but also that ensure that humans continue to be involved, both in the training of AI algorithms as well as in checking the outputs, so that we make sure that the outputs are correct, that they're adequate, and also that we're not introducing bias in the process. And one more thing, I think we also need to ensure that employees understand what the guidelines are. Where can they use AI? Where can they not use AI? What things can they do with it? So they absolutely must check. What can they not do? They cannot use personal data. They cannot use confidential data. But above all, it's about businesses being clear about where AI can be helpful to advance their strategy of the business, not get carried away in the hype, and be very clear about where it can really add value to the business.
Well, I suppose for we economists, we've been looking at the world over the last sort of 15 years and saying, why isn't productivity growing at the kind of rates that we saw around the 1990s, early 2000s? And I guess the other interesting argument is maybe this technology is going to come along a bit like electricity came along at the turn of the 20th century and revolutionized, rebooted productivity. So there's something quite kind of exciting in a world of relatively low growth, that historically technology really moves the dial on prosperity. So that's definitely something I think that I share your kind of optimism. Anna, we've covered an awful lot of ground. I think we did discuss whether it'd be possible to cover these sort of 5 massive consequential questions in this sort of time, but we've had a shot of doing it. If you had to leave kind of one message for this audience about all of this, what would it be?
I would say that we're certainly in times of massive transformation, and transformation sometimes can be daunting. But I think we have to see the other side of transformation, and it's the fact that it also opens up a great deal of opportunities. And I think this episode of transformation will be one that businesses can make use of in order to either future-proof their leadership position or to get to leadership positions in this shifting and changing landscape. So I think businesses have to be positive. They have to acknowledge the risk, but also go for the opportunities to future-proof their position in markets.
Yeah, I mean, I feel, and I've seen this in my time as an economist. I've been doing economics since the 1990s, and I think that for me, the big takeaway is that the world of economics has kind of intruded on all sorts of areas of life. So the sort of topics we're talking about, which economists worry about, I think are really core business risks. So I suppose my advice, complementing what you said, is that I think just keeping an eye on these sort of issues, because we find time and again that our clients find themselves, whatever their roles, talking to management about issues, sort of shocks and events which are driven by these sort of forces. So I think there is something about in a world which is clearly changing very rapidly, but also subject to big shocks, to just keeping on top of this vast area. But I hope we'll be invited back in 2 years' time to report on how successful our predictions have been.
Indeed.
But anyway, thank you very much indeed, Anna, and thank you for your attention today.
Thank you.